Marvelous. I want to thank all of y'all for joining the webinar today, hosted by the Niskanen Center. My name is Catrina Rorke. I do not work at the Niskanen Center, but I'm a big fan of their work and have been a partner for years. I run the research and policy programs at the Climate Leadership Council, where I spend a lot of time thinking about carbon accounting too. So I'm very much looking forward to this conversation where we're going to make accounting accessible, cool, and relevant to your work. So buckle up. What's on deck? We're going to have a presentation from Jia-Shen of the Niskanen Center on a really terrific new paper, From Green Goals to Black Ink, Reforming Carbon Accounting for a New Era of Competition. And then I look forward to moderating a discussion with Jia-Shen and some colleagues from whom I have learned a lot about on the carbon accounting and carbon policy front. We will have time for questions during that moderated discussion, so I invite you to ask them, and we'll get to them as we can. Let me do a little bit of stage setting that I hope sheds light on why we are talking about carbon accounting in this webinar and seemingly in every room across town. I heard it at Climate Week. I heard it at National Clean Energy Week. I'm hearing it in all of the events as we approach COP. What is carbon accounting? Why do we care? Let's dig in a bit. So maybe I'll walk us in from the perspective I come from. The carbon advantage literature has demonstrated that there can be really wide divergences in the emissions intensity of manufacturing. However, there are very few agreed upon ways for efficient manufacturers to demonstrate this competitive advantage that they have already invested in. How you make something matters for the climate, but we don't have the tools to demonstrate who makes what with the fewest emissions in a reliable and comparable way. That solution set has escaped us. At the same time, the landscape for competition is changing. We're seeing many companies want more visibility into their supply chains. They want to understand what their exposures look like. They want to understand who they're doing business with and what those operations function like. And countries are adopting policies that differentiate products on the basis of emissions intensity. Perhaps the most notable of these is the Carbon Border Adjustment Mechanism. The European Union is going to enter its definitive period on its CBAM on January 1st. The clock is running down on the policy, and then we're anticipating additional policies to roll on in 2027 in the UK and Taiwan. So things are shifting very quickly on the policy front, and yet we don't have the tools that we need to support this effort. We're also seeing sort of the dawn of disclosure requirements for investors and companies that require a level of disclosure and perhaps a level of liability that we've never seen before. So the weaknesses of the current, let's say, carbon counting toolkit are becoming higher and higher stakes. And I think that's maybe the most sort of clarifying gap for me is the difference between carbon counting, which we're pretty good at, and carbon accounting, which introduces a level of rigor, expected comparability that we just presently don't have. And the sort of carbon counting work, that's functioned through things like in the mandatory space in the United States, the Greenhouse Gas Reporting Program operated by EPA, where firms have to report annual facility level emissions. But we also see it in things like, the Greenhouse Gas Reporting Protocol, the Greenhouse Gas Protocol, from WRI and WBCSD that allows companies to develop something like a footprint of the emissions that cover their operations from like cradle to grave. So all of their supply chain emissions, all of their operations emissions, and then whatever product or services they make until it is expended, what is the emissions footprint? And those programs just aren't generating for policymakers, for firms, for advocates, the kind of clarity and reliability that we are hoping for. And so, hence the dawn of carbon accounting. It also just so happens that we are at this stage where tools like AI and blockchain can support the proliferation of these tools really quickly. And so a really nice moment to marry the sort of literature on carbon accounting with the needs of firms and policymakers in this environment of enabling technology. And it's my thesis that that's why we're talking about it in every room when it comes to climate change these days. You may have a different thesis. I'd be happy to entertain questions on that as we move forward. Let me introduce the panelists. They're going to help us get smarter, appreciate the global context that we are operating in, and understand where we are and where we need to go in the carbon accounting landscape. So first up, we're going to hear from Jia-Shen Tsai. He's a policy analyst at the Niskanen Center and the author of the report that is the subject of today's webinar. His work examines how carbon pricing and trade policy design can strengthen U.S. industrial competitiveness in a low-carbon economy. He is also affiliated with the Research Institute for Democracy, Society, and Emerging Technology in Taipei. Dr. Danny Richter is the director of the Pricing Carbon Initiative, where he engages a network of over 300 policymakers, business leaders, advocates, and experts on topics inspired by, but not limited to, carbon pricing. Previously, Danny served as the Vice President for Government Affairs at Citizens Climate Lobby, where he helped pass 5 climate bills signed by presidents of both parties. Not too shabby, Danny. And last but certainly not least, we have Minji Jeong, a research specialist at the EFI Foundation. EFI has also been developing really terrific literature around the sort of theme of carbon accounting. She advances evidence-based solutions to today's energy challenges, drawing from her background in business, research, and policy. Before joining EFI, Minji was a postdoctoral fellow at the Brookings Institution, where she focused on sustainable infrastructure, finance, and policy. She's also done time in the private sector at SK Innovation, a Seoul-based energy company, developing corporate climate strategies and managing low-carbon initiatives. So again, first we're going to hear from Jia-Shen, who will walk us through the paper, which lays out a really straightforward case for moving towards carbon accounting, and then we'll have a moderated discussion with the other panelists. Jia-Shen, over to you.
Okay, good. Everybody see the screen I shared? Great, okay. So hi everyone, Catrina, that was a very kind introduction, and you already summarized what this webinar is going to be about. I think that's also the key takeaway we want everybody to understand. Now I'm going to expand your very condensed introduction into a longer presentation. And yeah, so I'm going to explain why do we want to talk about carbon accounting and kind of giving you the context and defining what's actually at stake. So most of the audience today, I guess, might already have probably heard of or even worked with many carbon-related policies, such as carbon pricing, carbon credits, or carbon offsets, carbon reporting. All of them depend on reliable accounting. And the reason we care about carbon accounting is not just because we want to decarbonize the economy, but also because it's directly linked to the competitiveness of the U.S. industry. Industry. As carbon management policy multiply around the world, companies should pay close attention to how these carbon accounting is defined, so that if they're low carbon performers and their advantages could be reflected, and even if they're not, they should still improve efficiency to reduce their compliance costs to all these policies. So let's take a quick peek at the current state of carbon management policy to understand the environment that corporations are now facing. In the United States, more than 8,000 largest facilities are already reporting their emissions to the EPA through the greenhouse gas reporting program, like what Catrina has said. And at a corporate level, almost every company in the S&P 500, about 98%, reported their emissions to the Carbon Disclosure Project voluntarily last year. And globally, by 2025, the carbon pricing programs were in place across 50 jurisdictions now, covering 28% of global emissions. And if we zoom in at emission-intensive, trade-exposed industries such as aluminum, iron, and steel, more than 80% of emissions are already covered. And that is partially driven by the EU CBAM, which is about to start imposing their carbon border adjustment fee next year. And this graph is from a fantastic study that RFF have done. It found that since the EU announced that plan in 2019, the number of carbon pricing program worldwide has grown tenfold. The reason is very simple, because the EU allows countries with their own carbon tax to be exempted from their carbon border adjustment fee. So more countries started to implement them, and after most of the countries have their carbon pricing program, it would not be surprising to see more border adjustments in the years coming ahead. So now here's the interesting part. The EU's CBAM comes with its own embedded carbon accounting rules. But most companies are using a different rule books to prepare their annual emission reports, actually. And complying with one disclosure rule doesn't mean that the same data can be reused for another carbon border policy, because all these rules were developed separately right now. And that layering of carbon policies has created unnecessary burdens for companies that must reconcile them. And the CBAM even provided a table to compare the differences between itself and the most dominating disclosure rule right now. And I like to compare this to what happens when you buy new electronics. Like when you ever buy a new phone or tablet, it comes with its own charger. After a while, like you will end up with I think everybody will have that a drawer full of tangled cables, and none of which is going to fit the next device you buy. And that's kind of the situation of the carbon accounting systems worldwide right now. A point I want to make is we don't have that universal system that can fit all the purposes. And the most universal carbon accounting frameworks we have are actually designed for a very specific use, which is the internal risk assessment. And they're known as Greenhouse Gas Protocol and the ISO 14000 series, which gave us the familiar categories of scope 1, 2, and 3 emissions. I want to give everybody some background of Greenhouse Gas Protocol more. The Greenhouse Gas Protocol was the first corporate standard. It was initially published in 2001 and followed by a product level standard in 2011. The key feature of this framework is its life cycle approach. It asks companies not only to measure the emissions they directly produce, but also those generated upstream and downstream in their supply chains. And these are what we call indirect emissions. To be more specific, Scope 2 covers the emissions embedded in purchased electricity, while Scope 3 includes the emissions associated with the materials upstream and the use and disposal of its product downstream. So you can imagine, to figure out how customers use their products, such as for Apple, to figure out how long I use this laptop I'm using after I purchase it, it's a very daunting task, and it can become problematic to the carbon accounting. Assessing these emissions once can be helpful. For example, an automaker might want to understand how their production portfolio could impact their future market, but tracking those estimates every year doesn't necessarily help the company to decarbonize. And spending so much time and effort to measure something you can't manage, it actually carries a high opportunity cost. Companies are doing those calculations while not accounting in the expense of the time and resource that could be invested in more effective decarbonization tools. And because this process is so difficult, the protocol allows companies to use secondary or modeled data for supply chain estimates. And they're typically sector or regional average data. That tolerance to approximate data makes Scope 3 numbers across firms inconsistent and incomparable. And this wasn't a major issue when the data stayed internal, but until someone else started using it to compare. And now that someone else is the financial community, investors want to know how much climate-related risk exposure they're financing before they make decisions. The pressure also comes from international voluntary disclosure standard and financial regulatory bodies in some progressive states or regions, because they don't want to remake the wheels. They're installing these existing wheels that couldn't fit their car. And to recap, the current state is that different policies are asking different parts of the economy to track emissions in different ways. And the most emission-intensive trade-exposed industries face multiple overlapping reporting rules. Meanwhile, most other large companies follow a single carbon accounting framework, one designed mainly for corporate disclosure and doesn't fit the moving policy climate. Thus, what we argue that what we need is a universal carbon accounting framework that can feed into those different policy options, such as regulation, financial reporting, trade policy, you name it. We need one framework that is interoperable across all types of carbon management measures. Furthermore, because carbon emissions are invisible and intangible, it's best for the direct emitters to track them. And that means the system must be scalable, so small suppliers and medium suppliers can all participate. And this would also make it easier for the auditors to verify the data efficiently, and that verifiability would bring credibility to the whole system. And ideally, if the data are comparable, it can even create market incentives, allowing companies to compare and compete on carbon efficiency, where low carbon firms are recognized and rewarded. And to achieve that, we don't have to start from scratch, actually. The financial accounting profession has already developed a very clear system for this. And the most promising path is to borrow directly from them. Imagine every business transaction carrying not just a price tag, but also a verified carbon data attached to it. And when you add up all those transactions, you get a company's total emissions. That's what a ledger-based approach promises. And two emerging frameworks take this approach. The first is called the e-ledger system, developed by Robert Kaplan at Harvard Business School and Kartik Ramana at Oxford since 2021. It asks each company to collect verified emissions data from its supplier and then record its own direct emissions and then allocate all those data across its products. And then they can pass those information to its customers transaction by transaction. And if a company can obtain accurate information from the suppliers after a certain period, let's say 5 years, it must assume a conservative high emission estimate and creating a strong incentive for everyone in the chain to measure more accurately. That's one candidate. The other framework developed by the EFI Foundation is called the Comprehensive Carbon Accounting System. I'm not going into details here because Minji is going to introduce us to it more, but it also uses this ledger-based methods, but goes further by integrating physical mass and energy balances logic and create a transparent record of carbon flow and stock throughout the supply chain. And both systems are built on the same foundation. Companies measure and verify their direct emissions, share that information downstream, and like a value-added tax, it will eventually accumulate it to a whole life cycle emission for a single product. And if every industry adopt this, it will become a life cycle for every product. And of course, there are foreseeable challenges: how to implement it, who will govern it, how to ensure confidentiality, how to scale across industries. But the alternative is the fragmented landscape I just introduced, and one that costs companies more, confuses regulators, and undermines the credibility of carbon markets, and just not efficient enough. And that's kind of the situation we're in right now. But let me stop here and invite other panelists to comment. And I hope this context help everyone understand what's at stake right now and sets the stage for the discussion ahead.
Jia-Shen, thank you. The image of the drawer with all the cords in it feels really resonant in this moment, especially as in my work talking to stakeholders who are affected by the CBAM, but also affected by what's happening in California, and then also affected by updates to the greenhouse gas protocol. There's an abundance of cords in that drawer, that's for sure. You pointed out two themes that I think that Danny and Minji are uniquely going to help us understand. The first is that carbon pricing is expanding in response to this policy shift, and that's creating a larger and larger demand pull for this kind of rigor in carbon accounting. And the second is that theme of sort of like layering obligations and how we can cut through it and find more efficiencies and accuracies simultaneously, which is one of the things I've learned a lot from through EFI's process here. that Minji will help us understand. And so without further ado, let's hear from Danny and Minji. Danny, okay, so we have established that one of the use cases here for carbon accounting is to undergird carbon pricing policies. When you look at how carbon pricing policies are evolving around the world, what do you see? And how do you see the evolution of that policy set affecting the evolution of carbon accounting?
Yeah, when I look around the world, the things I see about carbon pricing are I see increasing ambition, I see a lot of creativity, and I see a growing focus on borders. And so on the first point, growing ambition, it's what you just said, Catrina, in the slide that Jia-Shen showed at the beginning from that great October of 2024 paper from RFF. The EU CBAM is driving a lot of ambition around the world in terms of both other countries adopting CBAMs and other countries implementing their own carbon price. And I think that two of the biggest countries that really turn my head are, number one, India. They passed a framework for having a national carbon price. It hasn't, all the kinks haven't been worked out yet, but that is the most populous country in the world with over 1.4 billion people, and they're going to be pricing carbon. The other one is Turkey, who is also, they've passed it, but that hasn't gone into place yet. These are two countries that are they play a big role in the minds of the globe. And when you, in terms of increasing ambition, there's a report that the World Bank does every year, the state and trends of carbon pricing policy. And in 2025, there was a 4% jump in terms of the percentage of emissions globally that are covered by a carbon price. It jumped from 24% to 28%. I think that's going to continue. One of my favorite stats to point out is that the United States is the only developed economy without a carbon price. Every other developed economy has a carbon price right now. And this really highlights, I think, something that we are vulnerable to in the United States, which is sampling bias. When you're in the United States, you're comparing yourself to other people who are in the United States, you're thinking about United States problems, and you can miss that literally every other developed economy already has a carbon price. You might think there's still an opportunity for the United States to still lead, when in fact there is not. So that's the ambition part of it. In terms of the creativity, you look at all these carbon prices, and it's all over the map. You have some jurisdictions that have a cap and trade, some jurisdictions that have a carbon tax, some have both. They think carbon pricing is so nice, they've done it twice. And then when you look at how they're spending the revenue, you have all these other ways that they're doing it. And the wonderful thing about this is the way a carbon price works, it's if you have the price, you're going to reduce emissions. And so however you impose that price, however you spend the revenue. When economists model it, the only thing that determines the emissions reductions is the price. So if you're putting a price on this, it's going to work. And so that allows a lot of flexibility for you politicians to match the needs of their constituents. So it's an extremely flexible policy that politicians can use to adapt to whatever needs their body politic has that keeps them in power. And then the third point, borders. I wrote a piece hypothesizing that we've entered a fourth generation of carbon pricing policy, and that begins with a border forward approach, where you're really thinking about the WTO and most favored nation, and you're thinking about national treatment. And when you do that, you are thinking about a CBAM. You can only have a CBAM if you already have a carbon price. If you don't have a domestic carbon price, it's a carbon tariff. But I think that border forward approach means you're much more likely to have an intensity standard, or not intensity standard, a performance standard, which is intensity based. Because of most favored nation, treating everybody the same and rooting it in the environmental benefits. So when I look around the world, those are the things that I see. And it's that border forward element of this current round of carbon pricing. That's where this paper becomes really significant. Because even though there is all this creativity, you can still have a common language. And one thing, perhaps the most important thing that I've learned on this call so far is that Jia-Shen loves an analogy, and I am here for that. This is something we share. And so I think that having that the border forward component, having this common language that you can apply that is familiar, the accounting analogy, and that I think that makes a lot of sense. I think that will make a lot of sense to companies, narrowing the scope of what they actually have to pay attention to. I love that figure, comparing the greenhouse gas protocol to e-ledgers. I think that really clarifies for me. This is less the companies have to pay attention to, and it's more comfortable for them. And I think that that's really going to help with the border component. So I'm excited about this moving forward, and that's how I think it plugs into the global trend of more carbon pricing policy, greater ambition, and really focusing on the border component.
Danny, thank you. Provocative to invoke adherence to WTO in the year of our Lord 2025. Perhaps we'll get into it further in the discussion. Minji, at EFI, you've done a lot of work to figure out how to take this from like concept to operational. How do you actually go about cultivating a carbon accounting system that satisfies what we hope, which is to create this forum for comparability, clarity, accuracy, etc. And so I'm hoping that you can share a bit about what you have learned in your own exploration of a ledger-based system, and how Jia-Shen sort of teed us up with that push for accounting, Danny's observations about the proliferation of use cases. If we're going to sort of reduce this theory of carbon accounting to practice, what key themes do we need to understand? What have you been learning?
Sure. So let me start with why we need a new carbon accounting system and why we need a ledger-based approach, building upon what's been discussed so far. So we need a new carbon accounting system because existing frameworks to quantifying carbon emissions is limited in providing the decision useful carbon information to stakeholders. And the gap is the largest for the product level carbon data, which is receiving growing interest from both the policymakers and the markets. Like Jia-Shen and Danny highlighted, the evolving policy landscape is requiring a common tool to quantify this product level carbon data. And also markets are also requiring this product level carbon data to make informed decisions in the low carbon products. But currently, we don't have a robust carbon accounting system to generate the product level carbon data. So currently, the most commonly used methodologies are based on the life cycle analysis, and or LCA, and these LCA models are commonly just combining this historical data and current data and the future data based on the assumptions of how this product will be used. So this, as a result, this kind of data is very hard to be verified and very hard to be compared across the products. And the additional challenge is that currently the product level carbon data is not reconciled with the entity level carbon data. So for example, if a company is measuring their carbon, they use the GHG protocol, corporate carbon accounting and reporting standard for measuring their corporate emissions. And to measure their product level carbon, like a product carbon footprint of their products, they have to use some kind of LCA models. And these two levels of data is not necessarily reconciled because they're using two different methodologies. And this could raise some questions about the integrity of the product level carbon data. So we are we started studying this ledger-based accounting because we believe the ledger-based accounting approach can solve these challenges. So under this ledger-based accounting system, a company has its own ledger. It's like a book recording every transaction that is affecting these carbon stocks and flows within the boundary of the company, like Jia-Shen presented. So the company is only just measuring this carbon in their control, and this information flows throughout the supply chain along with this movement of the products. So because the data is generated directly from the transaction based, so this data is more accurate and timely and comparable. And also, this company is just allocating all entity level carbon to the product level carbon. So this entity level carbon data and the product level carbon data are just completely reconciled. So, and this ledger-based carbon accounting is a proven tool in financial accounting. For financial accounting, every company has the general ledger, which is a book recording all kinds of financial transactions. And with this general ledger, the company can generate any kinds of the report statements and the metrics like a balance sheet, income statement, earnings per share, and any other types of financial metrics. What we envision is the kind of similarly working carbon ledger. So if a company has a carbon ledger recording everything, and then the company can generate any types of reports, any types of metrics, they don't need to use multiple methodologies. And at this point, maybe some of you have some questions that, okay, ledger sounds good, fancy, but would it work? So to answer that question, the EFI Foundation have been conducting 5 industry case studies to test the implementability of the carbon ledger. So we developed a model carbon ledger, and we applied that into these 5 industry case studies. And so for the first case study, focusing on the sustainable aviation fuel, we developed a hypothetical sustainable aviation fuel supply chain in Montana. And we assumed the 5 entities, the 3 suppliers of the feedstocks and fuel, 1 sub-producers, and the 1 airline as a customer. And we created carbon ledger for each of the 5 entities. And we also recorded all the transactions relevant to the flow of the carbon stocks and flows. So for example, the carbon associated with the feedstocks and fuel are transferred in from the suppliers to sub-producers, and the sub-producer making their product and allocate their entity level carbon to the product level, and they're selling it to the airline. And as a result of this case study, we were able to demonstrate that the sub-producer and the other entities can generate any kinds of carbon data, including their entity level carbon emissions and the carbon intensity of their 3 products they're producing. So yes, it works. So ledger-based accounting that helps overcome the challenges that current carbon counting and reporting world has, and it is a proven tool and it works. So I'll stop here.
How unprofessional. I muted myself. Minji, thank you so much. Okay, so now we get to the open discussion bit where we get to pick out all of these perspectives. And I think it's worth teeing up a little bit more understanding. And Jia-Shen, I think you can help us do this, of what carbon accounting can and cannot answer. So for example, it is clear that in carbon accounting, what we want an individual firm to be measuring are the emissions associated with their direct operations. But what carbon accounting, that approach can't answer is whether an employee's commute is relevant to those operations. So can you help us understand like what is in the domain of accounting versus the like policy decisions that ensure that we draw things like system boundaries or time values consistently across whatever carbon accounting approach we may consider?
Sure. I think, yeah, that's what Greenhouse Gas Protocol has been very good at. It lays out all these relevant carbon emission that may feed into a product, and not only the direct emissions, but also the commute emissions that may be fed into it. And I think what the ledger-based system is, they're trying to say the direct emissions and their suppliers' emissions is the most significant part for a product embedded emission. But those are still possible to be integrated to a ledger-based system if the companies want. I think that's kind of the design that ledger-based want to emphasize. And I think there are some important questions truly are not answered in the carbon accounting frameworks that we saw today. But surprisingly, the more I looked into this deeper, I found some of them are intentionally left to policy decision. And well, some might just because they're too sticky to decide in the guideline. But for example, should participation be voluntary or mandatory? The proponents leave it to policymakers, and because they believe policymakers should weigh broader considerations such as administrative capacity, industry readiness, or political trade-offs between enforcement and efficiency. And those are questions about governance and how to design the incentives for, or they can just mandate it without an incentive for companies to comply with it, but it's not about measurement and allocation. And that kind of thing that goes for defining materiality and boundaries. How much information is enough to make a meaningful decision for decarbonization or to tax to provide market signals? The proponents leave that to policymakers as well, and since each stakeholders in the supply chain might draw the threshold of materiality differently, policymakers can decide based on the policy goal whether they are going to regulate the producer or the buyer or the investor. So those materiality questions are really, some of them are really depends on the goal of the policy. And I think a common logic behind those design is that we don't want to why we want to set a fixed materiality is because we don't want to overregulate, because at some point there's diminishing return to collect the last bit of data. The marginal ton of CO2 that's tracked may cost more than it's worth up to policy design. And so, for example, the latest update from the EU CBAM last week illustrate that difference to a great extent. The Commission just adopted a new mass-based threshold that exempts importers bringing in less than 50 tons of CBAM-covered goods per year. And that one decision removes 90% of importers from the system, but still capture 99% of total embedded emissions. And that's a pretty good example for showing what's material enough for policy could be decided by the policymakers, and while the accounting rules live on its own. And however, the approach ledger-based frameworks are suggesting is to collect most of the data first, then decide which section you want in the application. So in all these conversations I've been involved in about carbon accounting, I kept hearing the term policy agnostic. And that's how the eLedger Institute, I think EFI Foundation also described their frameworks. And so a good accounting system in this view is like a set of Russian Tito's, another analogy, but you can slice it whatever level you need, from a product to facility to company. And the purpose of them is just to make sure every entity has an incentive to record its direct emission accurately, and then auditors can verify those records consistently. And whatever the policy need in that chain, they just slice it up and take what they want. So I agree with that philosophy to some extent, but I also would argue that the best carbon accounting architecture can live entirely in a vacuum. Eventually, it has to step into the policy or market world to be operational. And because it's there, it's in the regulation, the taxation, and trade, where those open questions about boundaries, materiality, and participation actually get resolved. So, and they just must have a stance for the policy to ensure the reputation and integrity of this carbon accounting frameworks to work. And although maybe not under the US political climate right now to step into policy first rather than step into the private sector first. So while the ledger can be policy agnostic in design, it still depends on policy's choices to define its scopes and purpose. And only when those choices are made can this enabler become a binding rule that really drives accountability in the economy.
Really helpful. Minji, in particular, I'd love your sort of gut response to Jia-Shen's observation that you need the policy to create sort of like a certain use case that clarifies these more sort of like poetic interpretation decisions around something like what is material to the emissions footprint. But I was also wondering if you could help us understand something that I observe, which is that people talk about trade-offs between collecting more emissions data. Jia-Shen just invoked this, collecting more emissions data and where like the cost benefit trade-off is, with the assumption that the more accurate and rigorous data you collect, the more expensive it is. But what we're seeing in a move to a ledger-based system is that every individual company can collect and report less. And so I'm hoping you can help us understand that tension and respond to Jia-Shen's question or proposition that the policy environment matters.
Yeah, sure. So a couple of weeks ago, we had a workshop with the stakeholders in the soft industry, and the biggest concern raised by them was the cost of data collection. So that is a very important issue. In terms of the cost, I don't believe that the ledger-based accounting would be more expensive than the current frameworks. So first, because each company is measuring only their direct emissions and the carbon only under their control, and this information flows through the supply chain. So they don't need to measure scope 2 emissions and scope 3 emissions. So it would be less expensive. And the second, the company does not need to use multiple methodologies. They don't need to use the different LCA models and the different GH protocol methodologies. So if they have a single ledger, this ledger can serve different diverse policy commitment or reporting requirements. So eventually, the ledger-based accounting would cost less than the current frameworks. But I completely understand that in the beginning of this implementation of the ledger-based accounting, maybe many suppliers would not be ready to provide any kind of data. So the companies should start with some secondary data. So I think it'll be very important to collaborate to build some kind of a shared data platform with a decent secondary data that the company can start with. And once we started just implementing the ledger-based system, we're going to have more and more data, so the data quality will be improved. And the last point I want to make is that so this carbon ledger can build upon the existing corporate systems. And actually, the EFI Foundation, we have our own accountant. So we tested that with our accountant. We just used the financial software when we tried to just build upon some kind of the balance sheet, carbon balance sheet, and we just created this hypothetical transactions. And actually, it was working quite well in our existing financial software. So I think the companies can just start thinking about the building upon this their ERP systems or financial accounting softwares. And as far as I know, there are ongoing efforts that integrating their ERP system with the carbon ledger. So those kinds of efforts would be very helpful to reduce the initial cost to implement the ledger-based accounting.
Helpful, thank you. I see questions coming in on the chat. Keep them coming. But Danny, I want to turn to you, this observation that the policy context matters, and you think a whole lot about the policy context. So can you help us understand what in the policy environment may keep us from adopting a ledger-based or clearer carbon accounting system more efficiently? What are the key issues that stand between us and this sort of world of more perfect information on the emissions associated with manufactured goods?
Well, one thing that I'll start that won't stop us. I mean, I think that having just heard Jia-Shen and Minji talk, I mean, if you weren't familiar with this, you might think that this is going across the entire economy, but it's not. We're really talking about a pretty small portion of the economy that is subject to these border carbon measures. It's the energy intensive trade exposed industries, and they're pretty. We know a lot about the people who do this, know a lot about how the inputs there and what it takes. And there are a lot of pretty big companies. So I think that that's, if you're sitting on the outside and this is your first time encountering this, that's one really key thing to understand is the companies who are doing this are generally pretty big companies with very sophisticated processes. They already know a lot about them. And that's going to get us most of the way there. So I mean, I think that that's an important context to this policy. I think that in terms of the rest of the world, I think it's useful to make a distinction between the United States context and the rest of the world. I think the rest of the world will be excited about this. I mean, we're going to learn a lot in a very short amount of time because, as you pointed out at the beginning of this webinar, the EU is going to start collecting actual money from companies in 2 months for their EU CBAM. And as Jia-Shen mentioned, they just released more guidance last week. So there's an element of building the airplane as it's set to launch. But we're still going to learn. We're going to learn a lot. And I think that one of the things that we're going to learn is that things are moving faster. We have better data when companies are focused on what they know best, and that's their products. And this framework, one of the reasons I'm so excited is that's all we're asking of companies in this framework. We want you to report what you know best, your products and the inputs to them, and record them in a common way so that everybody can understand that. So I think that the reason you are hearing this in all these rooms is because I think people are excited about this. I think they see how this is going to make their lives easier, is going to enable them to communicate with other companies across border, with governments across borders, and is going to save money for their bottom line. So I think this is going to be, I think there's a lot of excitement about this. In the United States context, it's more difficult. And I think you also have to grapple with the fact that the current administration is willing to slow progress on this. And as evidence, I point to the International Maritime Organization. Just a couple weeks ago, there was a vote on whether or not to actually adopt a carbon pricing system on shipping. It would have been the first sector-wide carbon price, global sector-wide carbon price. And the Trump administration went out of their way to swing votes against it. And so here you have the American administration, which is really trying to put pressure on other countries to move them away from carbon pricing. I think that sends a really strong signal domestically that this is not something the administration is excited about. And so I think that we'll see. Businesses, I think there are a lot of businesses who I think will be excited about this, who want the United States to do something in the United States. That's why we have seen some policymaking around this in the last couple of years. Whether that cracks through, I personally have some doubts. So anyway, you have this 2-track, very divergent pathways in the United States and the rest of the world. So those are my thoughts.
Thank you, Danny. So I'm going to observe the universe of companies that can adopt like a ledger-based system for emissions is near infinite. The network of companies that will be affected by these border measures like CBAM, that's more finite. And then somewhere in the middle is the universe of companies that will be impacted by disclosure requirements, some of which are carrying sort of like financial disclosure obligations. And so a question came in from a colleague in this carbon accounting space who observes that policy can create a really nice forcing function. Because, and what he invokes is there's an Apple case in Germany related to their claim that they've produced a zero carbon Apple Watch. And so they've been using a sort of an inappropriate measurement model to be able to make this assertion about a specific product that is then exposing them to some amount of liability where policymakers can come in and What he says, policy allows for data creation and sharing to create pricing signals, and I'll observe also like a sense of liability for operators. And so I would love to hear from one or all of you about your observations about that sort of like that murky middle where it's still in the realm of policy, but it's much more about disclosure and like the rigor of what kinds of claims you make about your products and how the carbon accounting framework can slot in that policy application, sort of independent of this sort of voluntary only ledger-based system, and then ledger-based systems to satisfy border measures. Anybody want to reflect?
No, I'll start us off. I mean, I think this goes to some longstanding concerns about what are negative emissions. You know, you get into carbon credits, sometimes called offsets. And I think Apple is a really interesting case because this is a truly global company, American manufacturing everywhere. And so, I mean, and one of the things that those who are participating in voluntary carbon markets worry a lot about is integrity. And this is just has been a tough nut to crack for decades. And I think that this system I think it could help with that. I mean, there's going to be a rough patch of discovery as we figure out where the points of friction are. But reading Minji's paper before this call, I was really struck with part of what you put on the ledger is negative emissions, and the example was, you're using, I think it might have been sustainable aviation fuel, so soybeans, that was negative emissions. And so when you put those negative emissions, which you could reasonably use to justify a zero carbon Apple Watch, and you put it within this framework of common accounting standards that people around the world are acknowledging, I think this could remove a huge source of reputational risk that companies like Apple are really anxious to avoid, and they just haven't been able to get rid of that risk in the carbon credit market space yet.
Oh, I can add something about this carbon credits and offsets. So we had a lot of discussions and debates with the experts in this field, and carbon mitigation activities, including carbon offsets and the environmental attributes. Those are the area that we are seeing the most disagreements. So the discussion is around that how we could balance this rigorosity and this flexibility. So we want a rigorous carbon accounting. Then the kind of the extreme side, we only measure this carbon removals, permanently remove the carbon only, and that is the most rigorous way. But in that case, what about the other carbon offsets from the emissions reductions and avoidances and nature-based solutions? We don't want to discourage the investment in these kinds of solutions. And one of the expert that we talked was saying that a ton is ton, the same ton. So you don't just ignore that. So it is kind of very difficult thing, and that is something that we need to work on a lot on this carbon mitigation activities, how we could record and what is the role of the accounting. So is this a policy area that some kind of deciding the eligibility of the carbon offsets? Maybe that is policy area, but how we could record in the ledger, that is some kind of a accounting area. So it's kind of there are a lot of work to be done.
Fascinating. Jia-Shen, you came off mute.
Yeah, to add on that, well, we might just run out of time, but from what I observe from eLedger's framework, Pro Center, and from EFI's proposal, this ledger-based framework want to stay away from those speculative avoidance credit. And although that might be useful to bring in more capital into the decarbonization efforts, but for the rigorous and for the sake of rigor and accuracy, these frameworks just want to record what has happened, not recording what will happen in the future. So that's kind of the difference between the avoidance and other removal that's both can count as carbon credit. And I think the removal and sequestration part is less controversial than the avoidance. So that's kind of the carbon credit that is going to be now developed in these ledger-based framework.
Yeah. Awesome. Okay. There are two sort of more straightforward questions that have come in from the audience. Let's answer those quickly, and then hopefully we have time for you to pause it. Where you think we will be 5 years from now before we time out. Okay, so first of these sort of straightforward technical questions. For some companies, the majority of Scope 3 emissions are from everyday consumer use. How would a ledger-based system account for product use? And who becomes responsible for following those emissions through the economy as consumers purchase those products? So that's one question, with the keen observation that this downstream sort of Scope 3 emissions set isn't going to be captured on the ledger. And I know, Minji, you've done some really interesting work on this. And then a second question is that Exxon has recently launched with 24 maybe other companies the carbon measures approach to carbon accounting. And do you have any reflections on how that carbon measures initiative relates to this ledger-based work? Thanks.
I can respond to the first question about the Scope 3 emissions from product use. So our ledger is recording not just emissions, we are recording also the physical carbon, which is not emitted yet, but it is contained in the product or materials. So company has this data of the carbon content which could be emitted during the product use. So if the customers are requiring that information, the company can provide that data, the physically contained carbon in the delivered products. So those data can be used for the customers to just calculate their kind of emissions from the use or end of life. And but this is different. There's a different question about the accountability. So who is accountable for these emissions? Who is in charge of have the responsibility of the emissions? That is what should be decided by the policy. So we are not just saying that who's accountable for that, but we are having this kind of the mechanism to just record this the entire all forms of carbon, including the physical carbon. So that can address some kind of the questions about the measuring the downstream emissions.
Thank you.
Yeah, I could add on to that as well, because Niskanen actually come from a carbon tax proponent perspective in the beginning, and I feel like actually a carbon tax is first of all it doesn't necessarily need a ledger-based system, but because you measure the beauty of carbon tax is you can measure the carbon content of fossil fuels at the point of extraction or import. You tax it once and then let the price signal ripple through the rest of the economy. But in that sense, it's an upstream instrument, and you don't need to know how every company or product uses that carbon downstream. But where the two start to interact is when this ledger-based system and carbon tax overlap is carbon border adjustment, and that's why we need a product level labeling. But I think what if this carbon accounting framework wants to be fit to whatever policy tools that's available out there, actually maybe the carbon content is one of the information that would be not so burdensome to the company to put on the invoice at the same time, and while maintaining its the ledger just recording what has happened before approach that like combining these two approach could actually make this ledger-based frameworks more versatile, in my opinion. But there's this different logic between just recording what has happened and recording what could happen in the future, and I feel like those are the points that this discussion needs to go on to take on. And But yeah, depends on the policy that we're looking at. There will be very different answer to that.
Awesome. Okay, so with 1 minute remaining, you are on the clock. You have 20 seconds to answer the question. Where do you think we will be in the carbon accounting landscape 5 years from now? Do we have universally adopted policies? Are policy mechanisms triggering new changes? Do we feel confident in the system, or are we still developing it?
I can go first. I feel like there will definitely be more carbon border adjustment around the world, and then everybody will have to get some try to harmonize those standards, and then there will be some prominent players come out that say let's have a universal one. And I think 5 years from now, that there at least will be some efforts trying to harmonize all the systems and try to come up with a universal standard.
Yeah, the push for interoperability.
Yes.
Danny or Minji?
Sure. I think the rest of the world is going to be moving forward. I think they will have learned a lot. I think this will be close to standard practice. I think the United States will be racing to catch up. And I think that other countries will have leveraged the carbon pricing systems that they've built against the United States. And I think that we'll see. The question I have is, how long does it take for politicians to listen to businesses who are asking them to adopt this?
Interesting. Minji, last word.
In 5 years, I hope to see some scalability that was emphasized in the Niskanen Center's newly released paper. I want to see that not only the large corporations and the small and medium companies, they're finding the carbon ledger is a cost-effective way to get the robust carbon data.
Awesome. Oh, thank y'all so much. This was fun. I love learning from y'all. I hope you in the audience enjoyed this discussion too. To my understanding, it was recorded and will be available on the website, so you can return to it again and again for continued education. This was great. I hope you have a really wonderful day, and I look forward to working with all of you on carbon accounting into the future.